Hi guys, welcome back to another video. My name is Josh and today we'll be discussing ARK's investment thesis on Bitcoin, and as well as that I'll be sharing my personal opinion as well as what I'm doing about Bitcoin. So you can find the links to the research paper that I'll be summarizing in this video in the description below. There's two parts to it, so be sure to check that out. And as always, I'm not a financial advisor, so don't take anything I say as financial advice. You can read the full disclaimer down below as well. So let's get right into it. ARK is a global asset manager specializing in thematic investing and disruptive innovation. The firm is rooted in over 40 years of experience in investing in technologies that aim to deliver outsized growth as industries transform. Their funds have easily beaten the S&P 500 in the past 5 years by a huge margin. Therefore, when ARK publishes research, I think it's worthwhile paying attention. In September 2020, ARK published a two-part white paper on Bitcoin. The first part highlights the merits of Bitcoin as a novel economic institution designed to challenge the current legacy financial system. This lays out the foundation for part 2, which discusses Bitcoin as an investment and ultimately ARK's investment thesis in the cryptocurrency. Before we begin, let me give you a quick recap and get you up to speed on what Bitcoin is. Bitcoin is a digital currency. There is no physical coin, only numbers on a distributed ledger, which is public for anybody to see. There is no central server nor storage, as the currency is decentralized and operates on a peer-to-peer platform. A Bitcoin address, which is similar to a bank account, can be created by anyone, and anybody can send or receive Bitcoin without approval. Bitcoin was created after the GFC in 2009 by a person who calls himself Satoshi Nakamoto. By the way, the guy in this video is not actually Satoshi. I just found this video on a website when I searched up mysterious guy because no one actually knows who Satoshi is. With that in mind, let's begin part 1, which highlights Bitcoin as a novel economic institution. The easiest way for us to understand the use case for Bitcoin is to compare it in relation to the current legacy financial system. The author Yassine Almandra sets the scene by laying out the 4 economic assurances that the legacy financial system falls short of, and explains why Bitcoin is able to uniquely address all 4 of these economic assurances. The first of these economic assurances that underpin an effective financial system is that value should be exchanged globally and freely. ARK believes that centralized parties determine the eligibility of participants to control the flow of capital. Examples include the likes of PayPal, who can and do censor users, as well as the instances where governments have restricted capital flows. With Bitcoin, on the other hand, anyone can participate in the exchange of value globally and freely because Bitcoin does not rely on centralized institutions to determine who can or cannot participate in the exchange. The second economic assurance is that wealth should be protected and wholly owned. ARK believes that the trust-based model fails because participants rely on a local enforcer to grant property rights and protect property. On the other hand, Bitcoin has an embedded independent property system. Bitcoin cannot be seized or stolen in the absence of the private keys, which are essentially the password to your wallet. This is particularly useful in jurisdictions with weak property rights, as suggested by its high usage in countries with unstable property right enforcement. The third economic assurance is that rules should be enforced reliably and predictably. ARK believes that the trust-based model fails here again because centrally controlled institutions can enforce and change the rules arbitrarily. As we have seen in some countries, mismanagement has led to the destruction of purchasing power. On the flip side, ARK believes Bitcoin incorporates a unique system of checks and balances to maintain integrity. Validators, also known as nodes, verify transactions according to the network rules, If a validator attempts to break these rules, then all other nodes will reject it. Furthermore, Bitcoin's monetary policy is reliable and predictable with a maximum supply of 21 million units, and new tokens are issued to compensate miners. The fourth and final assurance is that the integrity of the system should be verifiable. ARK believes that centrally controlled institutions lack transparency and auditability. The example they gave was that there had been a lack of transparency around commercial banking capital requirements leading up to the GFC. A flow-on effect of this was that auditors could not verify whether these banks had sufficient capital to cover the risk of default. Bitcoin, on the other hand, has embedded native verification tools. Bitcoin nodes provide the tools to enforce and verify the first three assurances, as summarized in the table here. To sum up part 1, where the traditional financial system falls short on the 4 economic assurances, Bitcoin meets all 4. And it is on this premises that ARK Invest builds the investment thesis for Bitcoin in part 2, whereby ARK discusses Bitcoin as an investment. Performance-wise, Bitcoin has just over 10 years of price history, and in that 10 years of price history, Bitcoin is the best performing asset class. As you can see here, during any yearly holding period since inception, Bitcoin's returns have been positive. But as always, past performance is no guarantee of future performance, so let's go into detail why ARK believes Bitcoin is the best monetary asset. ARK lays out 4 use cases for Bitcoin. The first use case is Bitcoin as a global settlement network. Currently, Bitcoin is more efficient at settling high-value transactions compared to low-value transactions, and therefore value is derived from handling large transactions between and among financial intermediaries. For example, for this transaction of roughly 405 million, it had only cost $6.09 to transfer. ARK's thesis is that if Bitcoin were to capture 10% of settlement volumes, then the Bitcoin network could scale more than 7-fold, from roughly $200 billion to $1.5 trillion in value as shown in this graph. The second use case of Bitcoin is as protection against the seizure of assets, which addresses the second assurance that wealth should be wholly owned and protected. The value of Bitcoin in this scenario is derived from the probability that a corrupt or misguided regime will confiscate assets, whether by fiat money inflation or by outright seizure during an individual's lifetime. And ARK mentions that if the probability were 5% on average globally, then Bitcoin's market capitalization or network value could vault more than tenfold from $200 billion to $2.5 trillion. The third use case of Bitcoin is as digital gold. Bitcoin could challenge gold as a global store of value because compared to gold, Bitcoin is easily divisible, verifiable, portable, and transferable. Therefore, value is derived from replacing gold as a store of value. According to ARK's research, if it were to take a 10% share of the physical gold market, Bitcoin's network could increase nearly $1 trillion, as shown below, 5 times its 200 billion base today. And finally, the last use case ARK mentions is that Bitcoin is used as a catalyst for currency demonetization in emerging markets. In countries with poor monetary policy and rampant inflation, this will encourage citizens to find a hedge against their own currency. One of those hedges could be Bitcoin, and therefore value is derived from Bitcoin being used as a hedge. If Bitcoin were to capture 5% of the global monetary base outside of the 4 largest fiat currencies, US dollar, yen, yuan, and euro, its market cap could increase by $1 trillion as shown below, a 6-fold increase from $200 billion today to roughly $1.2 trillion. With a combination of the 4 use cases, ARK estimates that Bitcoin could reach a $3 trillion market cap by 2025, representing an increase of roughly 10 times at the time of recording this video. In the chart it says 14 times, and that's because the price of Bitcoin has increased since ARK released this white paper. But on today's price as of recording, it is roughly 10 times. Now that we understand the potential upsides to Bitcoin as an investment, we must next decide how much of the portfolio we want to allocate into Bitcoin. To find the optimal portfolio allocation into Bitcoin, ARK ran a Monte Carlo simulation of a well-diversified portfolio, including assets such as equities, bond, commodities, currencies, real estate, and gold. The aim of this exercise is to find out two numbers. The first number is an allocation into Bitcoin that returns the highest return with the least amount of volatility, and the second number is the allocation into Bitcoin with the highest risk-adjusted returns, or in other words, this is known as the Sharpe ratio. So the Sharpe ratio essentially tells you how much risk your portfolio is taking relative to the returns that it is getting. The higher the Sharpe ratio, the better it is. So here are the results. Based on historical price movements of Bitcoin, the allocation to have minimum volatility in your portfolio while maximizing returns had been 2.55%. However, if you wanted to maximize your risk-adjusted returns, then the appropriate allocation was 6.55%. So understand that this is based on the historical price movements of Bitcoin. However, this isn't very useful because it doesn't suggest to you what the future movements of Bitcoin would be like. And so here ARK provides three different scenarios where Bitcoin would address 1% of the total addressable market, which means that Bitcoin has a market cap of 1.1 trillion and 5% of the total addressable market of 5.5 trillion, and also 10% of the TAM at $11 trillion. With a 1% TAM or a $1.1 trillion market cap, the position for minimum volatility and maximized returns is 1.15%, but the position to have the highest risk-adjusted returns is 4.8%. With a 5% TAM, this is 1.28% and 11.27% respectively, and a 10% TAM is a 0.03% allocation and a 25.78% allocation respectively into minimum volatility and maximum Sharpe ratio percentages. So personally, I think Bitcoin will fall somewhere closer to 1% TAM, and in which case I'm actually targeting around a 4 to 5% portfolio allocation into Bitcoin. So overall, ARK lays out some convincing arguments as to why Bitcoin could be a strategic allocation in a well-diversified portfolio. However, with all investments do come with risks, and there are quite a lot of risks involved with Bitcoin. The first one is custody risk. It is very common for exchanges to be hacked, and you can search this up and you can find a whole lot of history on historical hacks on exchanges with, large customers' funds being missing. And as well as that, if you put money in your wallet, your security of the wallet does depend on how well you can maintain the private keys, because that is essentially your password. If you forget your private keys, there's no way of retrieving that Bitcoin back. And secondly, there is a risk of regulation. Cryptocurrencies are a relatively new asset class, and regulators all over the world will be looking for new ways to regulate this asset class, because this asset class does intend to undermine the foundations of a centralized power. And lastly, there is risk that Bitcoin will become over-institutionalized. Specifically, Bitcoin users and investors could fall prey to the custody of assets by third parties, limiting the satisfaction of the first two economic assurances as explained in part 1, the first being value should be exchanged globally and freely, and number 2, wealth should be owned wholly and protected. So in my opinion, I think the most powerful force for the price of Bitcoin going forward is the increasing acceptance and increasing awareness of the cryptocurrency. And according to economic theory, a small increase in the demand for an asset with a limited supply will dramatically increase the price of that asset. Therefore, I do see Bitcoin as something as a call option, as the rewards are asymmetrical relative to the risk that you're taking. Mass adoption should see much higher upside relative to the downside, and hence why I am adding Bitcoin into my portfolio to specifically hedge against this situation happening. I'm currently targeting a portfolio allocation of roughly 4 to 5%, given the risks involved with Bitcoin and where I think Bitcoin is headed into the future. My preferred broker to buy Bitcoin in New Zealand and Australia is through Independent Reserve. I have a referral link down below in the video description. When you sign up, you do get $10. See the full details in the description box below. And my preferred broker outside of Australia and New Zealand is Binance. Again, I do have a referral link in the description below, so be sure to check that out. When you use the referral link, I will get a small kickback, and that would help the channel and help me continue doing what I'm doing on this channel. So I hope you enjoyed this video. If you liked it, be sure to hit like, and if you think someone will benefit from this information, be sure to send this video on to them as well, as that would greatly support the channel. So thank you for watching, guys. Until next time, take care.